It's my pleasure to introduce Dr. Andre Butler today. He's coming from the Institute for Financial Management and Research, IFMR, which is based in India, in Chennai, but it has many offices around India, and we have one office here in Hyderabad. Andre and I met a few weeks ago, and I found out that many of the topics that the Institute are doing are quite related to the work that we're doing here in ICRISAT, and particularly this mind theme. So I thought I'd invite Andre to come and give us a briefing on the Institute and also some of his work. He's got a PhD from University of Edinburgh. His PhD was actually a bit more on the biophysical side, so he was looking at savannas and forests and carbon balances and soil and so forth. So, but he's moved on to policy arena in the last several years. He's had some experience with ICRISAT, with a visiting science position in Mali in 2012 and 2013, and for the last 2 years has been based here in Hyderabad. He's working on a range of policy-related work, and one of his latest papers probably describes partly what he's doing. It's it's the title almost of his talk today. No policy is an island: agricultural finance and food security in India. So anyway, Andre, it's welcome.
Right. Okay. Well, thanks for inviting me here to give a talk. And like Anthony says, there's a lot of overlap between the work that we're doing at IFMR, and I guess what it can contribute somewhat to what your activities here at ICRISAT. So I guess what I'm going to do today is I'm going to give you just a background about what IFMR does, and the sort of work that we're doing in the agricultural arena. And then I want to talk a little bit about some work that I've done recently looking at agricultural finance and how that's had an impact or not on technology adoption, and think about what that means in terms of bringing finance and agricultural technologies together. So for those of you who don't know, IFMR is part of the JPAL IPA, the JPAL IPA network. So that's the Jamil Abdul Latif Poverty Action Lab and Innovations for Poverty Action, and they're based out of MIT and Yale, and they've sort of led the wave of RCTs in development. And so IFMR was as a partner to this group was formed in 2002, and it became the host institute for JPAL in India. And they still exist as separate entities, but side by side. Right. So essentially the idea about the bulk of the research that gets done within this network is that it's based on creating evidence-based policy decisions. So essentially evaluating policies or programs, seeing what works and what doesn't work, and not only seeing what works and doesn't work, but seeing what's most efficient. And this, when these policies and programs are scaled up, it has the potential to make taxpayers' money and things like that a lot more efficiently used. So how is IFMR different to JPAL and IPA? So JPAL and IPA are very much married to the randomized control trial approach, while IFMR has, I guess, the freedom to employ a lot more diversity in terms of methodologies that we use. So that's one of the main differences. The way in which IFMR and JPAL coexist in India is generally IFMR looks more at financial products and interventions, while JPAL looks at interventions in other areas like health, education. As Anthony said, our headquarters is based in Chennai, but we do have offices all around the country, and a large part of what we do is actually collecting primary data at the household level. So we have field offices in UP, we have one in Hyderabad, Ahmedabad, Calcutta, Bangalore. So we're sort of quite spread over the country, and that reflects the fact that we are doing work pan-India, and now also a little bit in Nepal and Bangladesh as well. So these are some of the agricultural projects that we've got going on at the moment, and actually some of these have finished. A few of the ones that I'm involved with are looking at soil fertility management, and how and why farmers aren't adopting more targeted soil fertility practices. Another project looking at agricultural mechanization and how that's impacting on the labor market. This is the study that I'm going to be talking about today, which it looks at how formal financial inclusion has impacted on technology adoption. And then we also we have worked with the CG system before. So at the moment we're doing a project with CIMMYT looking at adoption rates of conservation agriculture across 4 states in the Gangetic Plains. We've done a project with IFPRI looking at weather insurance. Actually one of the quite successful projects that we did was this mobile phone extension service, which was done by Sean Cole at Harvard. And it showed some quite positive results in actually giving farmers advice through a mobile phone network. And that's about to be scaled up. So, finance. So in terms of India's got a long history of quite ambitious and effective policies in terms of financial inclusion. And 2 of the landmark papers that have really looked at the impact of these policies were done by Burgess and Pandey in 2003, and the other one by Anjani Kocha in 2011. And they both looked at the social banking policies in the 80s and 90s in India. And they were more interested in how exactly these policies impacted on poverty alleviation. And so the first paper, Do Rural Banks Matter, found that the expansion of rural banks really led to significant reductions in poverty and increased non-agricultural output. So the reductions in poverty were actually driven by the tertiary sector and not agriculture. In a sort of, I guess, backing this up somewhat, Anjani also found big reductions in poverty. This paper was done pan-India. This one's focused more on UP, but still big reductions in poverty. And additionally, the finance was benefiting the more wealthy part of the population more, and so it increased inequality. And on top of looking at the expansion of rural bank branches, Anjani also looked at policies related to targeted credit, so channeling loans to the agricultural sector. And there she found very little impact. So the first question is why? Why are these financial products and things like that actually not benefiting agriculture? Because the widely held assumption is that farmers are liquidity constrained. They, at crucial times in the year where they need to buy inputs, they actually don't have the cash. So one of the things that we could think about is, are these technologies profitable? And whether or not these technologies are profitable depends a lot on how you measure them. So while high-yielding varieties is estimated to have accounted for more than 45% of the growth in food production in Asia, a recent study did a double-blind field experiment in Tanzania that looked at an improved cowpea variety. And they actually found that the entire impact was due to a placebo effect. So essentially the study population, a part of one treatment branch of the study population, didn't know whether or not they were receiving the traditional or improved variety. And they did just as well as the treatment branch that knew that they were receiving the improved variety. So, and so I guess what we can conclude from that is that the impact was actually down to effort in terms of management and things like that, rather than the variety itself. And then there have been a couple of studies that have looked at fertilizer in Africa, where adoption rates are still obviously quite low compared to South Asia. And these two studies took a very different approach. So the Duflo paper looked more at, they actually did it on a plot level, where they had different treatment branches at the plot level, measured the economic investment in all the different inputs, and took that approach, while the Beeman paper thought that it was actually more accurate to simply give farmers fertilizer and measure what they do with it. Because when you get, every time you receive or adopt a new technology or input, you readjust all of your other inputs. And they found exactly that, and the impact of fertilizer there, or the profitability, let's say, were increased between 28 to 63%. And one thing that's obviously clear is that the profitability of most technologies hinges on irrigation, which is no big surprise. So some of the constraints to adoption that have been proposed include information and learning barriers, behavioral bias, market failures. But what I want to talk about and focus on here is liquidity constraints. Loans, agricultural loans can really impact on technology adoption through two main channels. First of all, there's obviously the direct, where farmers are using the loan to invest in technologies that they otherwise couldn't have afforded. And the second one is that it actually reduces the risk of adoption because it can allow farmers to smooth consumption if things don't turn out as positively as they'd have hoped. So here we're going to be looking at how formal finance has impacted on technology adoption. So, like I said, India's got this long history of policies that have encouraged and promoted financial inclusion, and one of the policies that lends itself quite well to actually looking at the impact is something that they implemented in the 80s, and it essentially defined districts as being deficit or non-deficit based on a population to bank ratio, and also a proportion of the total outstanding credit of a bank, how much of the total outstanding credit actually went to the agricultural sector. So during this period, there was a massive expansion of rural banks. There were 30,000 rural banks opened across the country. And agricultural finance basically went from being next to nothing to 158 billion rupees. And obviously, like, it's distributed across disproportionately, I guess, especially in terms of agricultural finance. It obviously was a lot more heavily in the south. So I touched it, did I? Okay, very sensitive. Okay, so no, that's fine. So yes, so essentially the way in which banks were choosing to set up branches and the way that they were choosing to lend to farmers was based, their decision was based on agricultural productivity, so essentially which clients were going to be less risky in terms of their probability of paying back the loan, and things like that. So we have this joint dependency between access to finance and agricultural potential, let's say. But what we're really interested in looking at is that if you put a bank branch anywhere in the country, regardless of its agroclimatic endowment or whatever, what would the impact be on technology adoption on average? So in order to get rid of this form of selection bias, we used an instrumental variable approach, where we predicted the probability of building a new rural bank branch or increasing the lending to agriculture based on whether or not a district was deficit or not deficit according to the policy that was put in place. So we actually used data from ICRISAT, the village dynamics in South Asia, which gives district level indicators of technology adoption, among other things. And we combined this with data from the Reserve Bank of India, which has historic records of an inventory of rural bank branches and when they opened, as well as how much credit was outstanding to the agricultural sector in that year or period. So this was the policy that related to bank branch expansion. At the beginning of these bank licensing periods, the target ratio was 20,000 people per rural bank, and that was revised down in the second and third period to 17,000. So this is at the beginning of the study period. Don't know what color that is, but these sort of more brownish yellow color is what was considered a non-deficit, and the more olivey color were deficits. So essentially there was the policy was quite successful over the period in the fact that that there were a lot fewer deficit districts at the end. So this is our estimation strategy. This is the estimated number of rural banks. We controlled for things obviously like climate, anything that would have changed over the study period, so rural infrastructure like roads and things like that. These are district level fixed effects, so anything that stays constant during the, but is district specific, and then a year dummy to account for any macro shocks in terms of policy at the country level. So this was the policy for direct finance to agriculture. At the beginning, the target was 15% of the total outstanding credit, and then that was increased in the second and third to 16 and 18. And again, this is the distribution of deficit districts. So here you don't see such a massive reduction of deficit districts, but they're redistributed, I guess, which is quite nice because it actually makes us more confident in what we're saying in terms of the results. Again, this is very similar to what I showed you before. So what did we find? First of all, and importantly, there was good policy compliance. So banks expanded more rapidly in deficit districts, and agricultural credit increased faster in deficit districts. And so here we looked at indicators in terms of cultivated area, and we split this up into water-intensive versus non-water-intensive crops. And then we looked at high-yielding varieties and irrigated area. So in terms of the cultivated area, there was really no shift, and that's not really surprising. But one thing that we did notice was that there was a shift away from water-intensive crops with respect to direct finance to agriculture. In terms of high-yielding varieties, I guess these two things accompany each other. The fact that water-intensive crops are more likely to be high-yielding varieties. And so I think that just reflects that shift. And it's not really a disadoption of improved varieties, if that makes sense. And in terms of irrigated area, we found no impact with respect to the targeted lending policies as well as the bank branch policies. And I guess that's somewhat surprising in the fact that this is that you would expect some digging a bore well or something like this to be something that is reasonably costly and therefore finance could help with. But that wasn't something that farmers appeared to be investing in very heavily. So then we looked as well at fertilizer consumption. So the increased finance to agriculture had no impact at all on fertilizer consumption. And in contrast, and I guess this is one of the most surprising results that we found, the expansion of rural bank branches actually caused a decline in fertilizer consumption. And I guess that the explanation for that is that finance was giving farmers an opportunity to move away from agriculture, and therefore they were less inclined to invest in inputs and things like this. And that goes along with what I showed you earlier, where the earlier studies actually found that all of these financial inclusion policies actually benefited the tertiary and secondary sectors more than agriculture. And then in terms of machinery, there was, we saw a small increase in adoption of electric pump sets, which I guess has implications for irrigation as well as tractors. So I guess like a small shift towards mechanization there. So then we looked at what the impact on aggregate production at the district level is. And so we took all of the crops that were in the data set, and we evaluated them in terms of thousands of rupees, so that they're comparable across districts. Again, splitting between water-intensive, non-water-intensive. And we also looked at aggregate yields in terms of rupees per hectare, which I imagine is a unit that most of you aren't familiar with thinking about. Again, I mean, we didn't see any impact on investment or technology adoption. So not surprisingly, there was also no impact on aggregate production. And again, okay, so there was a small increase in the yield of non-water intensive crops. But this, I guess, is the main result that I want to highlight, and that's the disadoption of fertilizer and potentially other things that we didn't capture because we didn't have the data for it, actually caused a large and significant decline in agricultural output. So that's really what was a result that we found quite surprising. So in summary, the expansion of rural bank branches, so in a sense just increasing access to finance, really created an escape from agriculture. And as a result, we saw a decline in production, which is worrying, I guess, in terms of, has implications in terms of food security. And secondly, the targeted finance to agriculture was more or less neutral. It didn't increase production, it didn't increase investment, but it also didn't have any negative impact. And I would say that that's also a very disappointing result. And so I think that the widely held assumption up to now has been that financial inclusion, poverty alleviation, and promoting agriculture and food security have been complementary. And what these results suggest is that they're not complementary. Financial inclusion does have a significant impact on poverty alleviation, but it's leaving agriculture behind. And so that's certainly something that we need to address. And so coming back to this, which I showed you at the beginning, the Kisan credit card scheme, which is a subsidized agricultural credit scheme at the moment, cost the taxpayer in India 81 billion rupees in 2013 and 14 alone. So that's a huge cost to the taxpayer, and there's no evidence that it's actually improving agriculture. And so in the absence of evidence, that appears to be a bit of an inefficiency. And so what do we do? Well, I think that there needs to be some serious innovation in the agricultural credit sphere to make sure that if we're going to subsidize agricultural credit, we also need to make sure that farmers are investing in agriculture and not other things. And I think that that would go a long way towards improving this situation. And that's more or less it.
Yeah, very nicely captured many things, but my experience is something different, and there are many different stories if you are going at granular level. And whatever results are coming just opposite to many researchers, and that why I find is that due to aggregation problem first, and your result are showing that direct finance to agriculture as well as bank branches has a negative effect on technology adoption. And in fact, in irrigated agriculture, it is more negatively and significant, and positive with non-irrigated agriculture.
So that wasn't irrigated versus non-irrigated.
Yeah.
It was just water
Wherever,
intensive.
yeah. So there are two things. In India, we have around 140 million farmers, and around 70% are small and marginal farmers having less than 1 hectare land. And that is the biggest challenge even government is facing, that how to really practice that financial inclusion. Even if government has launched several programs, Kisan Credit Card or even Jan Dhan Yojana recently was launched, and still jury is out that whether Jan Dhan Yojana is successful or not. From government side, it is highly successful, but there are critics like even our own RBI governor. They are skeptical about this one, that okay. So accounts were open, money has been saved there, but after that what? And same thing even in our VDSA data, household survey data, so you might have used secondary data, right?
It's
District level data.
Yes, yeah.
So if you go to our own household level data, which we have good rich panel data from Eastern India and South India, again, results are similar. And in fact, recently we have published one paper also, and we presented at ERA conference at Mumbai last year. So what is happening, that you see that more number of farmers are in Eastern India, Northern India. And there you will find bank branches has expanded in rural area, but those bank branches are mainly taking deposits from those households.
Right.
They are averse to give credits to them. And that's why credit deposit ratio is very much inverse as compared to Southern India. It means they are taking money from that side and they are funding to either urban consumers or industry or some other parts of the country. So they are not really giving credit to them. Even if farmers has taken loan, then they are not interested to repay, just waiting for loan waivers. So thing is, what is happening, that if I am not having credit, I have not taken any loan, and if you correlate with technology adoption for me and credit, there is no really meaningful relation between these two. So in technology adoption, what we observe that it is more of that availability of technology itself is most important thing. If technology is not there, and then you will not find any relationship between finance, availability of finance, and then technology adoption. And that is happening in pulses. We are seeing in recent years a lot of attention has been given on pulses, and everywhere farmers are really crying. There is no availability of quality seeds. And same thing is happening with other technology also. In machinery, you will find very good relation, because there is a heavy investment is needed, and that's why there is no other way than taking loan from either bank or from friends and relatives.
In the mechanization study in Tamil Nadu, we're finding that the rental, that there's a huge willingness to rent machinery, but again, access is a big problem.
Yeah. So these are at a granular level picture are really different, and then again, I think you need to relook on those findings, that whether these relationships are really accurate according to the macro level.
Yeah, the results are really not believable. For as far as whatever I observed, and I have seen many studies and the publications. Many publications have shown quite good impact of relations between the credit availability in different locations. First, I wanted to ask, what is this is based on the only VDSA data, whatever results you are showing?
Yes. It's the
district level data?
It's the district, but it is like
secondary data. Yeah. So year, what is the year?
It's from 82 to 90.
As far as my personal observations and some studies have shown quite a good impact in terms of, and if you look at the many pockets, the fertilizer rates are not coming down in the irrigated regions, especially in the north, and the mechanization also increasing. At the same time, credits, even the credit card, as far as I am personally have at least kind of interviewed and talked to the farmers, thousands of them. So, but I would say that I think there may be some issues with the specification of the model as such. We need to look at more variables and how to really, as Ranjit mentioned, that maybe there are many things which might have missed and impacting the technology adoption, not directly relating to the whatever data you have.
Right.
So,
I mean, there's certainly advantages to looking at these sort of issues potentially at a household level rather than a district level. Absolutely. It doesn't make what I'm showing you here wrong. What I'm showing you here potentially has more implication in terms of food security, because you're actually showing it's actually showing that in that if you would not to have a rural bank branch, you would have potentially been producing more, right?
which is not the case actually.
Well, okay, that's your opinion.
No, not opinion. There are many publications. Just I give you one example of a production system which I intensively study for around 200 kilometers area, which is a potato growing area. I belongs to that area.
Right.
So if I look at the whole trajectory of last 25 years or 30 years, when the farmers did not have access to credit through this credit card, all small farmers were out of that production system. They were growing the traditional crops.
Right.
When this credit card scheme came, where the rate of interest is around 5 to 7%, and it's very easy. Every year they take the credit and then they again, earlier they were trying to get from the cold storage, which is very high cost credit. But now almost 80 to 90% farmers, whether small or marginal, have gone into that production system because of the credit access.
Right.
Because the input cost is very high, so that has changed the whole area. Almost 90% area is under one crop in that one season.
Right.
So that is direct impact of the credit supply. Otherwise, these farmers were not having access, which practically we can see there.
Yes.
There is no farmer which are not growing that crop now, which was happening before. So like that, there are many other production systems which we have seen.
So just to be clear, I'm not saying the credit won't work in any situation. That's not what I'm saying. Obviously, credit will work in certain situations, and before these policies came into place, and banks were I guess free to choose where they set up infrastructure and who they lent to. That means that in that situation they were choosing to go to potentially an area like this, which had a high potential for productivity, whereas these policies essentially redistributed that credit and tried to target it to more towards what they defined as being deficit districts, right? And so what these results are showing is what on average.
But it actually gives a wrong message to the policy maker that kind of you are giving this inclusion, whatever effort you are doing is making a negative impact. Now for last 5 years, government is making a very concerted effort in the eastern side of India, where the banks are there, branches are there, but these people have very poor access to credit actually. So if you have now good access, with the technology supply also they are trying to increase. So there is a huge potential to increase the production. So banks are there, branches are there, but still few people who are wealthy people, as you said, having access to that credit.
Right.
So there are many other factors which are working, not the credit
So
aspects here.
and I don't want you to, the message that I don't want you to take away is that we should stop delivering credit to farmers. That's not the message here. The message just is that we need to have systems in place that try and ensure that it benefits farmers. That's what I'm saying. I'm not saying that we should just not deliver credit to farmers. That would be a very bad policy.
Maybe some more analysis has to be done for that to give that message.
Absolutely, absolutely. I mean, we need to think about innovations that we could put in place that would help to resolve some of the issues in terms of leakages to other sectors and whatever the issues are, access to the technologies themselves. And, these are things that we need to think about to try and improve the efficiency of agricultural credit, not abandon it.
Thanks, Andre, for the presentation. There are two things. One is government has given the credit, but it has not resulted in expected outputs from agriculture. So that must have been siphoned by a class of, say, farmers. Mm-hmm. It can be rich farmer. It can be, if you disaggregate more into that, there is an aggregation problem there.
Yeah.
And that could have been one reason for the rising inequalities in the later period.
Yes.
That is one. Second thing is you have done up to 1990, isn't it? So post 2000, there's a very significant change in the first rural bank branching policies after this Narasimhan Committee report of the Reserve Bank of India. And then I think mid 2000, the direct finance to agriculture, which says priority sector lending. I think it's roughly around 40% of the total lending should go to agriculture.
Yes.
Mid 2000, there is a significant change in policy defining what is priority sector lending. Okay. Prior to that, you give only for primary production. But if you look at the policy after mid 2000s, see, food processing is involved, and the clients who take credit on food processing is basically multinational corporations. I mean, like that. So the number of loans are less, but the volume of credit is huge. So if you look at disaggregated level, who takes this loan? And since you've used RBI data, they have a disaggregated level data on amount of credit advance to different class of cultivators.
Yes.
So that can, there's an interesting hypothesis that a credit is given, but it does not go into real people. Real beneficiaries who can make an impact. So potential explanations can come from this disaggregated level data.
Right.
There are a few interesting papers on that. I mean, we can share.
Yeah, what you're saying is dead right, and what we saw from the Anjani Kocha paper is that inequalities have risen. And so essentially what you're saying is that, potentially larger farmers were benefiting more from that. But like you say, larger farmers actually represent a small surface area. So yeah, I mean, it would be nice to look at it at a more disaggregated level, but the two data sets didn't match up to allow us to do that.
One small, during our recent field visit, we saw tenant farmers can't avail the formal credit because they don't have the land title.
Right. Yeah.
So then they are the ones who need.
Yes, absolutely. And more recent policy has tried to.
No. Sure.
No, even now, more than 70% farmers, they are getting loans from informal sources, not formal sources.
Yes.
Yeah, that's one. And another thing is, many of the borrowers, they are over the period they are defaulters, so they are unable to get because of reducing fertilizer, not necessarily the availability of loan. Maybe some other reasons like a drought, continuous drought, persistent drought prevails in many parts of India. And and others, they expressed this change has come after 90s. I mean, many changes have taken place after 90s.
Yes. Yeah.
So now, but your data shows.
Yes.
Yeah.
So in terms of the fact that this is obviously historical data, this depends on what your views are on the external validity of any study. Like if you do a study in Tamil Nadu, is it applicable to Bihar? Maybe, maybe not. If you do a study in the 80s and 90s, is it applicable to now? In some respects, yes. Probably in a lot of respects, no. And there have been policy changes. And that essentially the policy has shifted from being a supply-driven policy, which it was then, to being a demand-driven supply of credit and access and all of this, which it is now. And the thing about the supply-driven thing is that it doesn't tell us what would happen if we would expand, if we were to expand the access and distribution of credit to other areas of the country, which at present aren't receiving what they should be, let's say.
In technology adoption also, government plays a very important role. They're providing input subsidy. For example, about 50% subsidy they are providing. Like mechanization, for technologies like drip irrigation. So about 75 to 100% government is providing. So not directly by that.
Thank you, Andrew, for the very provoking results, conclusions. Well, I find some, agreeing with the, that there are other factors which mediate technology adoption. I find some results of yours consistent with the earlier studies which very few studies which I read. And there has been a criticism on the regional rural banks after they have been established in 75. That the main purpose for which they have been established, to lend to the priority sector, agricultural sector, without collateral, basing on collateral and so on. There has been a criticism in the 90s that they have not served the purpose. They have not lent enough to the agricultural sector. But I find in your results you have mentioned that there was a lot of, in general, huge compliance.
In general, there was compliance. Yeah, I know that there was a lot of criticism. But generally speaking, I think, there were obviously problems. There always are. But in general, we do see compliance.
Yeah. The main thing is, that is one thing. And another criticism was about the leakages. Like any government scheme, like targeting errors. Of even for these subsidized credit, there have been a lot of targeted errors and like siphoned off. Not the most deserving people were getting. So I think that for some of your results are not surprising, but non-agricultural incomes are going up and agricultural incomes are going down. That's as a result of this is not surprising, but there are other issues like leakages and so on, and also the tenancy. The tenant farmer does not get because he does not have land title, so he cannot get the credit. Yeah. So that could be a reason where the adoption of technologies have been not so much in the irrigated, water intensive agriculture.
Yeah, right. I think that's...
No, I find this very, very fascinating, and I think we should use similar methodologies more often in our group as well, and we probably need also some support in developing capacities internally in these kind of methods. I'm not as critical as most of my colleagues are, and a message to our group is let's really consider that what comes out of studies like this could be closer to reality than our first intuition is telling us. I am very doubtful about the impacts we measure at highly studied sites where we cannot really tell the impacts we are observing, where are they coming from. So we might observe that, okay, there is now credit scheme implemented in a highly studied site, and now all of a sudden people are using the credits and do all sorts of things with it. But to which extent other interventions, which maybe are in our responsibility as well at these sites, contribute to that people are at all able to use the credits in a productive way, we cannot tell. And studies like Andrew's is telling us, given all other variables being constant, a certain intervention, what kind of impact does it have? I mean, one has to probably still look at what are limitations in the data, I mean, we don't know about your IV strategy. You didn't show us which instrument variables you have been using. Maybe one find weaknesses in the estimations. We can look at the paper and see there. So it's, I don't know, maybe there is something which one can look at and can try to improve. But in general, I would be very cautious to reject results like these just on the basis of our intuition we have from our huge field experiment. So that's one strong point I want to make here, and I would really love to use more methods like this when we want to measure impact, for instance, in minor irrigation, tank rehabilitation and other interventions which are related to this. At the same time, a message I want to send to you is be careful with the conclusions you are drawing. Maybe you should rethink how you formulate your conclusions. For instance, Anjit was pointing out, if the establishment of a bank system did not actually lead or does not maybe lead to more credits being indeed available, then that would slightly change the conclusions you are drawing. And there would also be, I'm almost done, sorry. And I would also maybe be careful with the conclusion that establishing a credit card system that is not effective from a policy point of view. You had the three circles. If you are saying that the financial inclusion mechanisms contribute to poverty alleviation, and this effect would still be there, then this instrument is still valid, even if it does not support the technology adoption in agriculture. So again, be careful what kind of conclusions you are drawing.
I completely agree with what you're saying. There are obvious limitations to the methodology that we've used. I mean, we've spoken about some of them, the fact that it's aggregated at the district level, that we don't know where the credit is going in terms of to what type of farmers and things like this. And so, yes, there are definitely limitations there. But I don't think, and obviously I'd love if you sort of read our paper in a bit more detail and to give some I guess, more specific criticism on it, but I don't think that it negates the results.
Before I comment, I would like to make sure that I understand correctly regarding the specification of the variables. So regarding this amount of credit distributed, you have measured that one through the number of bank branches, right? That one?
So the amount
of credit distributed, you have proxied that one through the number of bank branches.
So we estimated the amount of credit going to agriculture based on an instrument which is whether or not it was classified according to the policy as being deficit or not deficit. The bank branches is separate. The bank branches was estimated again by the policy definition of whether it was deficit or non-deficit according to a population to bank ratio.
So then you had this, for this amount of credit, you have actual amount of agricultural credit.
Yes, yes, direct.
And that was nominal across years, or it was this per hectare basis, or this total amount as a volume, or this was as a per hectare basis?
No, it was as a volume.
And this bank branches or bank density you measured through this number of population. Divided by that one.
Yes, yes.
See, here the specification matters to have that one. If we like to mention that one, that this adoption or this input use depends on this amount of the credit availability, then we need to have a similar measure. If we measure that one, that how much is the input used on a per hectare basis, we need to mention how much was credit given on a per hectare basis, that one.
Okay.
Same way, When it is that the bank branches or this bank density, we need to measure that one through this geographical coverage rather than the population, because over a longer period of time, which is 2 decades in your case, it naturally population has increased, and it would not be the same in the urban, semi-urban or this rural one, this rural township versus this remote areas we need to have. Other factors which you need to factor out, particularly the effect or this availability of this irrigation infrastructure, road and this connectivity, that infrastructure, as well as those other electricity and other which enables this availability and use of these technologies there. So because of non-considering those other relevant factors, we are getting this counterintuitive results. If you add those variables and specify that one, I am sure that we will be getting it in the positive direction.
Okay. In response to that quickly, because first of all, on the issue of area, we use district level fixed effects. The area of a district doesn't change over time, and therefore we control for it. Second of all, the population to bank ratio was simply a policy instrument that we were using, but we were estimating the actual number of rural banks from that. And we did control for infrastructure like roads and other things like that. So so they were in there. I may have not mentioned them explicitly, but they were.
It's not a question, I just want to make some comments. Short one, yeah, because a lot of questions are already asked. I am really very interested on your study, and then it gives an opportunity for our team. Actually, the main purpose of the VDSA which they created is to link this meso level and micro level evidences, how the macro level evidences can be supported through the meso level insights coming from the farmers. So I think there is an opportunity for the team to think of how we can your study and then the micro level evidences coming out of this village level study can be linked and then enhance the study what you are doing. One more quick thing which I want to know is how this institute IFMR is using any strategy to communicate your evidences to policy making. Or you just publish the reports, or you have any other strategy which you use to make your evidences coming out of your study to influence policies?
So up to now, it has been somewhat limited in terms of policy influence, but that's actually changing. We've now got MOUs with, I think, 3 or 4 state level governments where we have an agreement that we, being IFMR along with JPAL, will evaluate policies before they're scaled up to the population as a whole. So in terms of policy influence, that's a huge step. It just means that we get to evaluate policies quite rigorously before they're scaled out. And so that I mean, we'll see how it pans out. Obviously, the gap between research and policy is huge, but that's one step towards bridging it. So I guess I'll keep you posted on that one.
Okay, we better release you, Andre. Thanks very much for restarting a nice debate. And I haven't seen the economists get so worked up for a while, so it's good to see. So keep it up, guys. We need these kind of debates and to restart our thinking on a number of these things. Okay, so thanks, Andre. I think it's a good start to having some collaborations with your institute. So thank you very much.